What is an interest-only mortgage? Hi guys, it's Sam. Welcome back to the UK Mortgage Centre channel, or if you're new here, it's nice to meet you. Now in this video, I'm going to be breaking down interest-only mortgages. And now that I've got your attention, like always, why don't you subscribe? It's totally free, and that way you won't miss any uploads when I'm spouting off about mortgages and how to secure home ownership. So let's get into it. So as the name suggests, an interest-only mortgage refers to a type of mortgage where the borrower repays a mortgage payment but only the interest charges on the loan. This means that borrowers' monthly mortgage payments will not go towards paying off any of the debt that's been borrowed from the lender. The entire loan will still need to be repaid at the end of the term, and the maximum term for interest-only mortgages can be from sort of 25 years, 35 years to 40 years. This is unlike a traditional repayment mortgage where the borrower pays part of the interest and part of the capital off each month, which goes to the lender. Not only that, unlike interest-only mortgages, a repayment mortgage tends to come with more generous repayment periods, and more commonly up to 40 years. But exactly how do they work? Well, as you're going to be paying the interest on the mortgage loan, the monthly repayments are significantly smaller than those of a traditional mortgage. This gives you, the borrower, more financial freedom each month to use that money differently, since the repayments are going to be lower. However, it is important to bear in mind that these monthly payments will not reduce that mortgage loan, and 25 to 40% deposit is often required to secure an interest-only mortgage. Instead, these payments will simply cover the interest to prevent the original sum of money from the mortgage loan getting any bigger. As a result, at the end of the loan period, the borrower will still be required to pay back in full the original loan amount. By way of illustrating, if a borrower obtained an interest-only mortgage for £150,000 over a 25-year period, they would still owe £150,000 at the end. You get the point. Instead, their monthly repayments would cover the interest on the mortgage loan amount only, preventing the size of the loan from growing. At the end of the loan period, the borrower must repay the loan either by selling the property, digging into them savings, or remortgaging and changing it to a repayment mortgage. Now let's look at how a monthly repayment would look like. And all you need to know is the size of the loan and the interest on this amount. So for example, if you contact a lender to borrow £150,000 and the interest on this sum is 3%, then the annual interest on this mortgage deal will be £4,500. This means your payments will be £375. Over a 25-year repayment mortgage, this means the total amount of interest you would pay is £112,500. You'll then be required to pay the £150,000 of the original loan at the end of the term of the period, meaning you'll have paid £262,500, which would be the overall cost of obtaining this property using an interest-only mortgage. Now, if you're interested in an interest-only mortgage and you like this video, then give it a thumbs up, and if you do have any questions on anything I've mentioned in today's video, give a member of our team a call on 01925 573 328.